Hello, Adam from the Mortgage Hub.
Hello.
Okay, I've got a question for you about limited company mortgages. Buying through a limited company sounds a bit heavy, but in plain English, why are so many people doing it?
Limited company buy to let is definitely becoming more and more popular. The main reason for that is the supposed affordability benefits and taxation benefits. That's worth pointing out at this stage. I'm not a tax advisor. I'm not an accountant. I've got sort of no qualifications in that area, but I am a mortgage advisor. So I do understand that if you get the right advice, that limited company might be the right option for you. So once upon a time, if you wanted to enter the rental market, you go to an advisor, bank, building society, and you would get a buy-to-let mortgage. Now, buy-to-let mortgage is a rental mortgage. The Prudential Regulation Authority, they oversee those type of mortgages, and affordability is generally based upon the rentability of the property. So how much rent is coming in each month and what's the value of the property? This is how much money we're prepared to lend you. Your own home mortgage, residential mortgage, it's what's the property worth? What do you like as a person? How much do you earn? And how much can you afford to spend each month on your mortgage payment? So the affordability is different on both those types of mortgages. So the rental mortgage itself, it's based on the rent of the property. Now, what's happened over the last few years is that um, the amount of tax that you might be liable for on the rent has changed, depending on whether you're a low rate, basic rate, higher rate taxpayer. And so the income that you receive from the rental property will impact how much tax that you might be liable for. Again, not a tax advisor. So with limited company buy to let, what you've actually set up is a business. So the business itself owns the property, and you, as the director of the business, you providing personal guarantees. And so the money is actually being lent to the limited company, not to you. And that limited company then is taxed the way that corporations are taxed. And so you can draw an income from that company if you want to, and the company pays corporation tax. Again, you'd need to speak to a tax professional about how all of that works. But the reason that more and more people are doing that is because there are taxable benefits for doing so, and it is an efficient way to get a mortgage. Why is it an efficient way? Well, again, once upon a time, those type of mortgages, there was higher rates, higher fees. There wasn't any practical, let's say, cheaper benefit in getting that mortgage. You were paying a premium for doing it through a limited company. But what I will say is those margins have heavily reduced. And so a limited company, in terms of interest rates, in terms of the fees, that type of mortgage is about the same as a normal personally owned buy-to-let mortgage itself. And so it is becoming increasingly attractive. There's more and more lenders that are entering that market. We'll see a lot more of that over the coming weeks, months, and years, especially probably with the Renters Rights Act. So if you're thinking about getting into buy-to-let, or you already own properties at the moment and thinking about expanding your portfolio, and you want more information about whether or not the limited company mortgage might be better for you, give us a call on 0121 323 4999 and we'll help you out.
Thank you, Adam.